right, so today we're looking at the balance sheet, which is also called the statement of financial position. The whole concept behind the balance sheet is that it must follow the accounting equation. And the accounting equation is assets equals liabilities plus capital. All right. So the total assets of a company must equal the liabilities and the capital. Assets are things that you own. Liabilities, that this is what you owe. Capital, this is money and resources that are put into a business by the owner. Now, for grade 9, the balance sheet, you are going to use the format which is fixed assets or non-current assets, which are also called fixed assets, plus working capital equals capital employed. Hello, Walia. I'm fine. Yes, so I'll look at the balance sheet. Yes, we'll look at the balance sheet. So the balance sheet should follow this format. Non-current assets plus working capital equals capital employed. Working capital, this is the money that is used for running and paying day-to-day expenses for a business. Capital employed, which consists of, just hold on. Capital employed consists of long-term liabilities, which are also called non-current liabilities, and it also includes capital, the owner's capital, the capital of the business. The definition of capital employed, this is the money used for expanding the business so that the business can generate profits. So let me just write them down. Working capital, money used for the day-to-day running of the business. Now, working capital, the formula of how to get your working capital, it's current assets minus current liabilities. Okay, working capital. Are you able to see my, or do I need to zoom the screen? Are you able to see clearly? Okay. Working capital, current assets minus current liabilities. All right. Then capital employed so it's used by the business to generate profit. Okay, so for your balance sheet, when you add your non-current assets or your fixed assets plus your working capital, which is also called sometimes as net assets, must equal the capital employed. So we've got an example here so that I can illustrate. So We've been given information about a certain company. All right. So here we have drawings. Drawings, this is money taken out of the business for personal use. Sometimes cannot even be money. Sometimes can even be equipment, stuff taken from the business by the owner for their personal use. All right. Capital, this is the money and resources used to start a business. Cash, well, we all know what cash is. We've got bank, this is money in your bank. Loan, this is a loan which you get from somebody or an institution like a bank. Creditors, these are people you owe money. Debtors, these are people who owe you money. Right? Then stock here, this is the goods which are used for resale. Okay. So let's make our balance sheet. So the first thing that we're going to put in our balance sheet, first we put the title. So say balance sheet for X Limited as at 31st December 2022. So the balance sheet is going to have three columns here. We're going to start with our non-current assets, also called the fixed assets. Non-current assets, these are things that you can own for more than a year. Okay, so for our non-current assets, we've got land. This is the most permanent amongst all of them. You can list them in the order of permanency. So we start with land. The land is worth 145,000. The next we've got equipment. 240,000. And finally, we've got motor vehicles. $260,000. All right, so we add up. So that we get our total non-current assets. So I'm going to say 145,000 plus 240,000 plus 260,000 get 645,000. All right. After you list your non-current assets, you're going to come to your current assets. All right. We list them in order of liquidity. Liquidity is just converting these current assets into cash. Right. So we'll start with the least liquid of all the current assets, and that is stock. What's the value of the stock? That is 300,000. So you put this in the first column where there are the kwacha symbols. You put it there. So you're going to stock 300,000. Next, we have debtors, people who owe us money. Let me see, debtors, 40,000. Then we've got bank, 40,000. And finally, we have cash, 5,000. So we total up our current assets. Right, stock plus debtors plus bank plus cash, 385,000. All right. Next, we're going to list out our current liabilities. This is what you owe that must be paid within a year. So we've got, let's see what our current liabilities here. Okay, we've got only creditors. Right, so here it's creditors. So we can put this here in the second column since that's the only one. So we say creditors. How much? 80,000. We're owing 80,000. So after you've listed down your current assets and your current liabilities, next thing that you need to find out is the working capital. Working capital is found by deducting current assets from current liabilities. All right, so I'm going to say 385,000 minus 80,000. We get 305,000. That's our working capital. So let's calculate our net assets. In other books, you see it as written as employment of capital. The books, you see it as net assets. So we're going to say 645,000 plus 305,000. We get 950,000. Any questions before I go further? Okay. All right, then you're going to say here financed by, as I said, here when we're talking about what the financing is, the long-term liabilities, which are like loans and the owner's equity. All right. That's what consists of the capital employment. Let's say financed by, and you're going to say owner's equity. And you're going to say capital. What's the capital here? 650,000. Oh, I forgot to put one important point. The net profit for the year. This comes from the statement of profit or loss, right? You have to include it also in the balance sheet. You're always going to add it to capital. So net profit for the year is 400,000. So we're going to add, as we're going to say, owner's capital 650,000. Then we add net profit 400,000. We add these two. That's going to give us 640,000 plus 400,000. Going to give us 1,050,000. Then we're going to deduct drawings, because remember, the owner takes this money out for their personal use, so it's taken out of the business's capital. So drawings was 150,000. So this has to come here, 1,050,000. So drawings 150,000. Deduct that. 1,050,000 minus 150,000. You get 900,000. Right, then we're going to add our long-term liabilities. This is what you owe, and it can be paid after a year. You don't have to pay it within a year, right? You can pay it after some years. And these are usually the loans, mortgages. Sometimes you're going to see words like bonds and debentures, all meaning the same thing. So we're going to have 50,000 here. So you're going to say 900,000 plus 50,000. That's 950,000. So this is the capital employed. All right. So as I said earlier, your net assets, which is fixed assets plus working capital, must equal the capital employed. So here our balance sheet has balanced. Any questions? Mhm. No, they always have to give you net profit. It would be wrong if they don't give you net profit. No, because remember, what is the purpose of the statement of profit or loss? to calculate a net profit or a net loss, right? So before you make your balance sheet, you have to remember you have to start with the trading account, then statement of profit or loss. So they'll never forget to give you this information about net profit. If it's a question where you just have to make the balance sheet. If they do, then you won't be able, the balance sheet won't balance. So they will always give you